The IRS just released the 2026 tax changes, tax brackets, and contribution limits. And for most working professionals earning between $80,000 to $300,000, these changes directly impact your paycheck, your tax bills, and even how much you should contribute to your 401k, IRA, or HSA next year. And here's the surprising part. Even though some of the deductions are increased in 2026, most people will still end up paying more taxes because of the new tax bracket shift. And in this video, I will break down the exact 2026 tax bracket, the new standard deductions, the updated 401k, IRA, and HSA limits, and what does this mean for you if you earn 100k, 150k, or 250k. And also I will cover how to legally reduce your taxes before the rules hit. I retired at 41 using only my salary and smart planning, and understanding all these rules early was one of the biggest advantage I ever had. So stay with me and I will walk you through a real working couple example showing how tiny adjustment can save thousands under these 2026 rules. And of course, none of this is a financial or tax advice. We're just having fun with Uncle Sam. Let's start by answering the only question that really matters. Will these IRS changes increase or decrease my taxes? And for most working professionals, the honest answer is it depends on your income level and how much of it falls into each of the 2026 tax brackets. Now, let's lay out the exact numbers. For single person, 2026 deduction is $16,100, which is an increase of $350 compared to 2025. For married filing jointly, it is $32,200, which is an increase of $700. And for head of households, it's $525. So this is roughly a 2 to 3% increase. So yes, the deductions did go up, but let's put that into perspective. So what does this increase actually do for you? Let's say you are a married couple filing jointly. Your standard deductions goes from $31,500 to $32,200. That's a $700 increase, right? So here is how it affects your taxes. If you are in the 22% bracket, 22% of 700 is $154 in tax savings. $154. So yes, the increase is nice, but it's not enough to change your financial life, which is exactly why the next part matters. Your 2026 tax brackets. Here is exactly how your income will be taxed in 2026 if you file as single. It will be 10% up to $12,400. It will be 12% between $12,400 to $50,400. Then you can see the numbers for 22%, 24%, 32%, 35%, and 37%. That's the highest bracket. And these are the exact brackets. No rounding, no estimated numbers. These are the exact numbers. And here are the official bracket if you file jointly. Understand that these are numbers after your standard deductions. So it is 10% for 0 to 24,800. That means this is not your first $24,800. That is already the standard deduction. This amount is after that standard deduction. Then it is 12% from the numbers you can read by yourself. Then it shows the numbers for 22%, 24%, 32%. It is 35% if you are between 512,000 to 768K. And 37% is the highest. Let me break this down in simple words because numbers are only useful when you know what they mean, and I'm only useful if you subscribe before I explain the next part. Now, brackets have expanded slightly from 2025, on average around 3%. That means you can make a bit of money before moving into the next tax bracket. But this is the part most people miss. That 3% expansion does not cancel out the higher overall tax burden many people feel once they get their bonuses, RSUs, promotions, side income, side hustles, anything on top of your salary. If your household income is closer to 260 to 300K, now you're flirting with that 32% tax bracket, which starts at $403,551 for married filing jointly. Why the flirting? Because you might earn 260K or 300K on paper, but your taxable income is often higher once you add the RSUs, bonuses, gains and dividends, and investment income. That's why many families with 260K salary end up crossing the 32% bracket without even realizing it. And this is where strategy becomes extremely important, like how much you put into your 401k, whether you use your HSA or not, whether you defer your compensation, and how you time the stock sales. All of this will affect whether your income stays under or jumps into this bracket. Your tax bracket determines how much of your raise you keep, whether your bonus hits a higher tax rate, whether your RSUs push you up a bracket, and how much of your side hustle income is worth keeping, and even how effectively your 401k contributions are. And this is why we are spending time on the exact IRS numbers, because a lot of your financial decisions in 2026 will revolve around these thresholds. Now that you understand where the 2026 tax brackets fall, let's talk about the part you can actually control: your retirement and health saving contributions. Because here is the simple truth: you cannot control what tax bracket you fall into, but you can control how much of your income get taxed. This is where your 401k, IRA, and HSAs become powerful tools, especially if your household income is in between 120k to 300k. Let's go through the exact 2026 limits and how to use them. In 2026, the IRS increased how much you can put into your workplace plan, like 401k or 403b. Employees who are under the age of 50 can contribute up to $24,500. The catch-up contribution for people above the age of 50 is $8,000. Total with employer match is $72,000. So in plain English, every dollar you contribute to your traditional 401k reduces your income by $1. If you earn $150,000 and put $24,500 into your 401k, the IRS only taxes you on the $125,500 before the standard deduction. That single move can keep you fully in the 22% tax bracket and protect more of your raises, bonuses, and shift thousands of dollars from tax today to tax later, possibly at low rates. For IRAs in 2026, contribution limit is $7,500 and catch-up contribution is $1,100 for people above 50. A traditional IRA contribution may reduce your taxable income depending on whether you or your spouse are covered by a workplace plan or your income level. A Roth IRA, on the other hand, does not reduce your taxes today, but the money grows and comes out tax-free in retirement. For many working professionals, the usual order of attack is max out the 401k up to at least the employer match, then use HSA if available, and then look at the Roth IRA or the backdoor Roth depending on the income. For next year, the health saving account limit are for individual coverage, it is $4,400. For family coverage, it is $8,750. And catch-up contribution is $1,000. Now, why this HSA matters so much? Because HSA is the only mainstream account that is tax deductible going in, tax deferred while growing, and tax-free when you use it for qualified medical expenses. Plus, if you invest that HSA money instead of spending it every year, it effectively becomes a stealth retirement account for future healthcare. Now, let's talk about something almost every working professional gets wrong: the capital gain taxes. Capital gains are just the profit you make when you sell an investment. Like you bought a stock for $5, you sell it for $12, you gain $7. Simple. But the tax rate you pay on that gain depends on two things: how long you held the investment and where your taxable income falls inside the capital gain brackets. Let's break it down in simple English with the real 2026 numbers. If you hold the investment for less than 1 year, this is called short-term capital gains. Whatever your tax bracket is, 22%, 24%, 32%, that's the tax rate you pay. If you hold the investment more than 1 year, now you qualify for long-term capital gains and the tax is way lower. Here are the official 2026 long-term capital gains brackets. For a single filer, it is 0% up to $49,450. It is 15% for the range mentioned there, and it is 20% for anyone above $545,500. For married filed jointly, it is 0% up to $98,900. It is 15%, 20% for the mentioned range there. Now let's take an example here. If your taxable income from your salary, bonus, RSU, etc. is $110,000, then your long-term gain automatically start in the 15% zone because you already crossed the 0% zone, which ends at $98,900 for married filers. And this is where most people mess up. They think 0% capital gain means all their gains are tax-free. No, only the portion that remains below the threshold is tax-free. First, your salary fills that bucket, then your long-term gains sit on top. Your gains don't push your salary into higher brackets, but your salary can push your gains into higher tax brackets. Long-term capital gain taxes don't raise your tax bracket. Your tax bracket decides how your long-term gains get taxed. In 2026, your taxes won't change because of one big rule. They'll change because of how all the rules stack together: your bracket, your deductions, your retirement contribution, and your capital gain timing. If you understand these 4 levels, you can legally keep thousands of dollars in your pocket without changing jobs, without working more hours, without complicated strategies. And most people will wait until 2026 and get surprised. But you are here now and you already know what to do. If this has helped you, bhai ek subscribe to banta hai yaar. Your finance friend Sushant, signing off.